$13.4 billion. That was the size of the iShares Silver Trust at the start of 2025. A respectable number, a quiet number, the kind of number that sits in a spreadsheet and nobody talks about at dinner. 12 months later, that number had nearly tripled, and by early February of 2026, it had exploded past $46 billion. Somebody moved billions of dollars into a single silver fund, and most people on Earth have absolutely no idea it happened. Today, we are going to pull this story apart, piece by piece. We are going to follow the money, trace the panic, unpack the crash, and try to understand why the biggest names on Wall Street are suddenly obsessed with a metal that most people associate with jewelry and old coins. What you're about to hear is not speculation. It is documented in filings, in tonnage reports, in central bank disclosures, and in the price charts that have turned the precious metals market into the most volatile corner of global finance. Let us begin with the number that started this entire chain reaction. On the 29th of January, 2026, silver hit an all-time high of $121.88 per ounce. Not adjusted for inflation, not a futures projection. The actual spot price, $121, for a metal that began 2025 trading near $29. In the space of 12 months, silver delivered a return north of 145%, obliterating the performance of the S&P 500, obliterating Bitcoin, obliterating virtually every asset class on the planet. Forbes called it the best-performing commodity of 2025, and that was not hyperbole, it was math. But here is where the story gets genuinely strange and genuinely important. The very next day, on the 30th of January, President Donald Trump announced his nomination of Kevin Warsh as the next chairman of the Federal Reserve. The market interpreted this as a signal of tighter monetary policy ahead. Within 28 minutes of the announcement, gold plummeted $380. Silver did not just fall, it collapsed 26% in a single trading session, one of the worst single-day crashes for the metal in over 4 decades. In certain exchanges, including India's MCX, the drop hit nearly 30%. Leveraged traders were liquidated by the thousands. Margin calls cascaded through the system like dominoes on a tilted table. And yet, within a week, silver clawed its way back. By the 7th of February, the metal had bottomed near $75. By the 10th of February, it had recovered to roughly $81.50. As of the latest data, silver trades around $81 to $82 an ounce. The recovery was fast, violent, and telling. It told you that beneath the speculative froth, something structural was holding the floor. That something is the supply deficit. The Silver Institute, the primary industry body tracking global silver flows, confirmed that 2025 marked the 5th consecutive year of structural supply deficit. Let that sink in for a moment. 5 straight years where the world consumed more silver than it produced. The cumulative shortfall from 2021 through 2025 stands at approximately 820 million ounces. To put that in perspective, 820 million ounces is roughly equivalent to an entire year of global mine production. The world has effectively consumed an extra year's worth of silver from above-ground inventories over the past half-decade, and those inventories are not infinite. The Silver Institute released its latest report on the 10th of February 2026, and the headline was blunt. 2026 is on track for the 6th consecutive annual deficit. Total global silver supply is expected to rise only about 1.5% in 2026, reaching a decade high of approximately 1.05 billion ounces. That sounds like a lot until you realize that demand continues to outstrip it. Industrial fabrication alone, while forecast to decline modestly by about 2% to around 650 million ounces, still represents an enormous baseline of consumption that does not disappear when prices spike. And this is the critical point that most casual observers miss. Silver is not just a precious metal, it is an industrial metal. In 2024, the solar photovoltaic sector alone consumed over 6,000 tons of silver, representing 29% of total industrial silver demand. Every solar panel on Earth relies on silver paste for electrical conductivity. Each kilowatt of solar capacity requires roughly 9 grams of silver. By early 2026, the price rally in full force. Silver had become approximately 29% of the total production cost of a solar panel, according to Bloomberg. That is a staggering number, and it creates a paradox. Solar manufacturers need the metal regardless of price. They can try to thrift, they can attempt substitution, but silver remains the best electrical conductor known to materials science, superior to copper, superior to gold, and replacing it without performance loss is not a simple engineering problem. Meanwhile, electric vehicles require nearly twice as much silver per unit as conventional automobiles. Consumer electronics continue to increase their silver content as devices grow more complex. Defense applications, driven by geopolitical tensions and military modernization worldwide, add another layer of demand that operates largely independent of price sensitivity. Now let us talk about what the institutions are actually doing, because that is where the real signal lives. The iShares Silver Trust, ticker SLV, is the largest silver-backed exchange-traded fund in the world. At the start of 2025, it held approximately $13.4 billion in assets under management. By year-end 2025, that figure had surged to roughly $38 billion. As of early February 2026, it stands above $46 billion. During 2025, the fund averaged inflows of approximately $2 billion per month. The daily trading volume now exceeds 175 million shares. This is not a niche product anymore. This is a mainstream vehicle that institutional allocators, pension funds, and wealth managers are actively deploying capital into. CNBC reported on the 27th of January 2026 that retail traders were buying a record amount of silver. The SLV fund climbed nearly 6% on that single day, pushing its year-to-date gain past 52%, while extending the prior year's roughly 145% advance. The enthusiasm was not confined to one geography. In India, silver ETF inflows surged 139% month over month in January, reaching over 9,400 crore rupees. But the institutional story goes beyond silver ETFs. Central banks, those slow-moving giants of global finance, have been accumulating gold at a pace that rewrites the historical playbook. According to the World Gold Council, central banks purchased 863 tons of gold in 2025. While that represents a 21% decline from the record pace of prior years, it remains historically enormous and geographically widespread. The significance is not just the volume, it is the message. Central banks are telling you through their actions that they are diversifying away from dollar-denominated reserves. They are telling you that they view hard assets as a necessary hedge against the monetary and geopolitical uncertainties of this era. Gold itself has responded accordingly. As of early February 2026, gold trades above $5,000 per ounce. JP Morgan forecasts gold reaching $6,300 by the fourth quarter of 2026. Wells Fargo has lifted its year-end target to a range of $6,100 to $6,300. Deutsche Bank sees $5,500 as a baseline, with $6,000 as a realistic possibility. Goldman Sachs calls gold its highest conviction long trade. And here is where the gold-silver ratio becomes critical to understanding the silver thesis. The gold-to-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. As of early February 2026, that ratio sits around 61 to 64, depending on the day. In May of 2025, before the silver rally truly accelerated, the ratio stood near 100, meaning gold was historically expensive relative to silver. The ratio has compressed significantly, but bulls argue it has much further to fall. Bank of America's head of metals research, Michael Widmer, has issued what may be the most aggressive precious metals forecast in recent memory. He projects silver could reach between $135 and $309 per ounce in 2026. The lower target is derived from the gold-to-silver ratio hitting 32 to 1, which is where it bottomed in 2011. The upper target uses the 14 to 1 extreme that occurred in 1980 during the famous Hunt Brothers silver squeeze. With gold trading near $5,000, applying those historical ratios produces those extraordinary price targets. Widmer himself is careful to note that these are scenarios, not guarantees. He acknowledges that the $309 level represents a cap rather than a certainty. But his broader point stands. Even if the extreme scenario never materializes, silver may still significantly outperform gold from current levels simply because the ratio remains elevated relative to historical norms. Goldman Sachs is more measured but still bullish, projecting silver to average between $85 and $100 per ounce in 2026. Citi and several institutional analysts view $100 to $120 as a more sustainable upper bound for the year. Let me be clear about why this matters beyond the numbers themselves. When you see the largest silver ETF on Earth triple its assets in 13 months, that is not noise. When you see central banks accumulate hundreds of tons of gold year after year, That is not a passing trend. When you see the fifth, now heading toward the sixth consecutive year of silver supply deficit with cumulative shortfalls approaching a full year of global production, that is not a temporary imbalance. These are structural shifts in how capital flows through the global financial system. The Fresnillo story is a perfect microcosm. Fresnillo is one of the largest primary silver producers in the world, a major Mexican miner. On the 28th of January, 2026, the company cut its silver production guidance for 2026 from a range of 45 to 51 million ounces down to 42 to 46.5 million ounces, a 9% reduction. This happened while silver prices had more than doubled. Think about that. The price of their primary product went through the roof, and they still could not maintain production targets. Mine plan changes, operational delays, and geological realities do not care about spot prices. Opening a new silver mine takes 7 to 15 years from discovery to first production. There is no quick fix for a supply shortfall of this magnitude, and the supply side is only half the equation. On the demand side, the green energy transition represents an entirely new source of structural silver consumption that did not exist at meaningful scale a decade ago. Global solar capacity is expected to reach approximately 665 gigawatts by 2026. Every gigawatt requires silver. Artificial intelligence infrastructure, which demands enormous quantities of electricity, is accelerating the build-out of solar and other renewable capacity. The data centers being constructed to power the next generation of AI models require electricity. That electricity increasingly comes from solar installations, and those installations require silver. It is a chain of demand that feeds on itself. Now, some observers will point out that high silver prices encourage substitution and thrifting. That is true, and the Silver Institute acknowledges this dynamic. Industrial silver fabrication is forecast to decline modestly in 2026, partly due to thrifting in the photovoltaic sector. But here is the catch. Even with thrifting, even with manufacturers desperately trying to use less silver per panel, the sheer growth in installed solar capacity means that total silver demand from the sector remains enormous. You can reduce the amount of silver per panel, but if you are installing twice as many panels, you end up consuming more silver, not less. The volatility we witnessed in late January and early February of 2026 also deserves careful examination because it reveals the market's psychology. The crash from $121 to $75 in roughly a week was dramatic. It rattled retail investors. It triggered massive margin calls. It dominated financial headlines. But the recovery was almost equally dramatic. A 10% gain on February 7th, another 7% on February 9th. By February 10th, silver had recovered to $81.50, which is still up roughly 15% year-to-date and up approximately 150% from where it began 2025. The crash was triggered by a specific catalyst, the Warsh nomination, which markets interpreted as hawkish for monetary policy. But the recovery was driven by something deeper. It was driven by the recognition that silver's fundamental supply-demand picture has not changed. Central banks are still buying gold. The supply deficit is still widening. Industrial demand is still growing. The green energy transition is still accelerating. A single personnel announcement at the Federal Reserve, however significant, does not erase 5 years of cumulative supply shortfalls. An analyst at CME Group described silver's price action between September and November of 2025 as a rally of almost 50% in barely 2 months, a surge that eclipsed the gains of virtually every other asset. The description used was a multi-layered confluence of market conditions. That confluence has not dissipated. If anything, it has intensified. There is another dimension to this story that receives less attention but may be the most consequential of all: the role of geopolitics. The United States is engaged in a broad realignment of trade relationships through tariffs. The relationship between Washington and Beijing remains fraught. Military tensions persist across multiple theaters. The absence of clear de-escalation signals in the Middle East, combined with ongoing conflicts elsewhere, means that capital continues to seek shelter in hard assets. Gold above $5,000 is not an anomaly. It is a reflection of a world where trust in paper currencies and sovereign promises is eroding incrementally but relentlessly. Silver benefits from this dynamic in a way that is uniquely powerful. Unlike gold, which is primarily a monetary and store-of-value asset, silver sits at the intersection of monetary demand and industrial necessity. When geopolitical tension drives safe haven flows, silver benefits. When industrial growth drives manufacturing demand, silver benefits. When the green energy transition drives solar installation, silver benefits. It is the one metal that touches all three of these megatrends simultaneously, and that is why its price action has been so explosive. Let us talk about what the options market is telling us, because sophisticated traders leave footprints. The put-call premium ratio for March 2026 silver futures stands at 0.92. This means that while more money is still positioned in call options, betting on higher prices, the cost of protective puts has risen sharply. Bears are now paying nearly as much for downside protection as bulls are paying for upside exposure. This tells you that the market has moved from pure euphoria to a more balanced but still constructive positioning. The smart money has not left the trade. It has hedged the trade. There is an enormous difference between those two things. The retail investor, watching this from the outside, faces a genuinely difficult question. The move has already been enormous. Silver has risen from $29 to over $80 in roughly 13 months, with a spike to $121 along the way. Is it too late? Have the gains already been captured? The answer depends entirely on which data you choose to emphasize. If you focus on the short-term price chart, silver looks extended and volatile. If you focus on the structural supply deficit, it looks like the shortage is actually deepening. If you focus on what the major banks are saying, you find Bank of America targeting 135 to 309, Goldman Sachs targeting 85 to 100, and multiple other institutions maintaining bullish outlooks. If you focus on central bank behavior, you see the largest coordinated accumulation of hard assets in modern history. There is no consensus, and anyone who tells you there is one is not being honest. What there is, instead, is a body of evidence that suggests the precious metals cycle is not over. The train has left the station, yes, but the question is whether it is a commuter train making one more stop or an express headed much further down the track. The Silver Institute's February report offers one final piece of data worth considering. Total global silver demand is expected to remain essentially flat in 2026, at just over 1.1 billion ounces. Total supply, even with a modest increase, reaches only about 1.05 billion ounces. That leaves a deficit, the sixth consecutive deficit, and each deficit year draws down the world's above-ground inventories a little further, tightening the physical market a little more, making the next price spike a little sharper. The history of commodity markets teaches a consistent lesson. Structural deficits do not resolve themselves politely. They persist quietly, ignored by most participants, until the market suddenly realizes that the metal is simply not there in sufficient quantity. Then the repricing happens all at once, violently, in moves that seem irrational in real time but look obvious in retrospect. Silver may be approaching such a moment, or it may have already entered one. The tripling of the SLV Trust's assets, the central bank gold buying spree, the 5 years of cumulative deficits totaling 820 million ounces, the crash and immediate recovery, the production cuts from major miners despite record prices, the insatiable demand from the solar and electric vehicle sectors. These are not isolated data points. They are pieces of a single coherent narrative. The narrative says that the world needs more silver than it can produce, and that reality is beginning to matter. Whether silver reaches $100, $135, the extraordinary $309 that Bank of America floats as a ceiling, no one can say with certainty. Markets are complex, adaptive systems. They surprise everyone, bulls and bears alike, and they do it on their own schedule. But the data is the data. The deficit is the deficit. The institutional capital flows are documented. The central bank purchases are audited. The production shortfalls are reported in corporate filings. And the iShares Silver Trust did not grow from $13.4 billion to $46.2 billion because of a rumor on social media. It grew because money, vast quantities of money, decided that silver was somewhere it needed to be. Pay attention to what money does, not what commentators say, not what headlines suggest. What money actually does, where it moves, in what volume, and at what speed. That is the only reliable signal in financial markets. And right now, money is moving into precious metals at a pace that demands your attention. I do not advise anyone to invest in anything or to buy anything. I share data and analysis that may help you understand what is happening in the world. Subscribe to the channel if you found this video valuable.